Welcome back, everybody. We're here at MSP Confidential. That means it's time to bring on a special guest today. We've got Hartland Ross, founder and managing partner of the Host Broker. Hartland is a guy who spends time on both the buyer and the seller side of M&A transactions all the time. And it feels like we gave way to AI, and the M&A conversation has kind of disappeared from the event space to some degree. Not entirely, but AI is the topic du jour. And so I wanted to bring it back because why not? AI is maybe taking the media cycles, but certainly M&A is continuing to be a big deal behind the scenes. Hartland, welcome to the show. Thanks for joining me to come and have a casual conversation about how maybe valuations and things like that are changing in the face of AI. How have you been lately?
Yeah, look, it's been a treadmill here. We've been running hard now for a while. 2025 has served us well, so I'm doing well. I'm just trying to keep all the balls in the air, and it's been good. I just got back from IT Nation actually, so coming
Yeah.
off the heels of that.
Balls in the air, I think, is a perfect way to describe a bit of how maybe a lot of MSPs are feeling with this AI pressure. Certainly, every vendor's talking about it. Vendors are kind of scrambling to get some kind of AI into their products, tick the proverbial marketing checkbox, so to speak. But I think in terms of valuations, in terms of M&A activity, I'd love to get a sense from somebody who's on the ground level with this kind of conversation. What are you seeing happening right now in terms of the re-rating that maybe AI is driving in terms of valuations? Is it really affecting sort of valuations and multiples yet, or is it topical but not yet making a big impact? Tell me a little bit about what you're seeing out there.
Yeah, look, I mean, I think it's pretty exciting, and the two pieces come together, right? It's like, well, as you said, there's sort of AI taking the spotlight, but like M&A has actually kind of had the spotlight for a while, but it's still very active, and I think that those are two um, key topical areas that, if at a conference, are running concurrently, are certainly going to be competing for each other. In terms of AI adoption, I mean, if I was just, as I said, at IT Nation, and the hands go up around surveying of who's adopting AI and kind of where they're at, and really the consensus is we're still like really early days, and there are early adopters, but the most groups are still kind of in the infancy there. And then of course there's also like, what is AI, right? Like, is AI, I have proprietary systems and applications running that we've built, or am I using an off-the-shelf tool as part of my stack that's got an AI component to it? So like, you can have that kind of conversation. So there's different levels of utilization, and so I think almost every MSP probably at some level will be using AI, just the mere fact that they're using third-party tools. But
Yeah.
in terms of like impacting valuations, we're not there yet. At least we haven't seen that. I think one of the things that we're actually we're in the process of, and need to do a little bit more of, is we're constantly tweaking our intake process and our questions that we're asking sellers in terms of like how their business is structured, and where the value is, and so to try to wrap our hands around what the seller is doing from an AI perspective,
Sure.
as kind of part of the value proposition, is
Yeah.
going to be key.
Well, you mentioned infancy, and I kind of begs a bit of the question if there's maybe other areas that, despite the years that we've had with M&A exposure, are perhaps still a bit in the infancy state as far as getting ready for a transaction or something like that. And I'll explain. I think my sense, and you can correct me if I'm wrong, is that there are perhaps more buyers than sellers at the moment. A lot of people interested in coming into the space. And this means that perhaps they open their books up to younger businesses, or lower overall turnover or gross revenue businesses that perhaps means they're in their infancy stages of many other things or parts of the business. And so I'm curious what you're seeing there in terms of like how early in the growth stage of MSPs are buyers kind of looking at now compared to a few years back, if it's changing at all.
Yeah, well, I mean, this is very much a, a relative concept, right? Because you've got the large private equity groups or other strategics that have been coming into the space or have grown in the space now for, in some cases, for a number of years, who are attracted to the space and are doing acquisitions. But of course, their threshold for size is quite a bit greater than an owner-led strategic buyer that's doing a couple $1 million of top line. So those guys have a different set of criteria and thresholds with respect to EBITDA and margins and criteria and industry and targeting and location and so forth. So they're pretty selective about who they're looking for. What we're seeing and it's been a continuum. I wouldn't say there's some significant change here in the last year necessarily, but is the smaller MSPs. So there's always somebody who's interested in buying somebody else, right? So
Yeah.
I say there's a $20 million MSP who wants to buy the 5 or 8 or $10 million MSP. There's the 5 or $10 million MSP that wants to buy the 2, 3, $4 million MSP, and there's a 2 or 3, $4 million MSP that wants to buy the $500,000 3-person operation. So there's something for everybody. Just kind of question of where you fit into that food chain, if you like. But in terms of the sophistication, obviously, and maturity levels are going to be commensurate with the size of the business. But so you kind of see everything, and there's something for everybody. And although groups may have preferences for more operational maturity than they're getting, you're going to get what you get at a certain size of business, and you got to have set your expectations accordingly.
Yeah, yeah. Well, definitely more and more PE groups are kind of making their incursion into the market, looking to start perhaps with an anchor acquisition that'll be the beginning of a quote unquote platform roll-up strategy, perhaps. And there seems to be a lot of interest in finding those anchor MSPs that can drive a platform strategy for them. And I'm curious, if you're finding that each one of these PE shops comes in with a slightly nuanced or different thesis on what they think they can do
Yeah.
with a platform roll up. Because I find that maybe there's a little bit of ego, perhaps, that plays a role in how some of these want to go do their own thing. We can do it better. We can drive more value creation. We can do whatever X number of things. And so I'm just curious, what you hear on the ground of some of these theses coming into the market.
Yeah, well, I think the first bifurcation of that question is whether the group has an existing platform already, or whether they have a thesis but no platform, right? And we're seeing a tremendous number of groups that are wanting to come into the space. They're attracted to it for one reason or another. They've been told that there's opportunity here, and so they're saying that this is what they want to do, but the reality is that they don't have any experience in an IT business, or certainly not an MSP, and that is a really difficult sell to a seller who is now going to be handing over the keys to their baby. They want to see that be successful. They want to see their customers taken care of, their employees taken care of, and how many people want to do that, to handing it over to somebody who doesn't really know what they're doing. Now, some groups will be a search fund, and so there's somebody who's got experience running a business but doesn't have one now, so they're going to be kind of leading it, and they're backed by private equity or family office or whatnot. But the other side is the groups that have an existing platform now, and as you said, there really are a lot of flavors. Like this sort of idea of like, well, there's just private equity, and private equity doesn't have a very good name, and they know it. And so how do we differentiate ourselves, right, if we're coming in with that? And so I think it's really important to not not paint everybody with the same brush, right? Is the term. So to understand what their thesis is, what their approach is. For example, like, are they going to retain the brand? Are they going to allow the seller, if the seller is going to stay on, to continue to run the business and be autonomous and keep their staff and keep their employees, or is the brand going to be rolled up into something larger? Do they, if they're keeping equity, do they get to keep equity within the business that they currently own, or are they getting a stake in some larger piece of the pie? And what are the implications of that down the road? Particularly, now you're really kind of buying into the larger vision of all of the other roll-ups and the value creation that is supposedly going to be had from that. So so there's pros and cons, but like, these are the types of things that need to be discussed and considered.
Yeah. Maybe let's pivot a little bit into more mechanical components of how MSPs might be thinking about their seller's journey today. And I think, I participate heavily in the ConnectWise Evolve community, for example, where we sit with a lot of MSPs in their boardroom meetings and their conversations. And something that they do particularly is they spend a lot of time talking about legacy and an actual life plan. And I think this is expanding beyond the Evolve community specifically to be just something that's more present to business owners today than I felt it has been in the past. And so I'm curious how much of this legacy planning is kind of creating maybe more stringent selling requirements on the seller's side. They like you said, they want their customers looked after. They don't want to sell for selling's sake. They're kind of looking to hit a specific magic number that they've ideated as part of their legacy and life plan and so on. And so where perhaps before MSPs were maybe happy to get any kind of offer, it just meant there was interest. And I think a little bit of ignorance on the mechanics of deal making on their part maybe got them not the best deal all the time, but I think a lot of them are getting more savvy to what things can be turned and screwed in the mechanics of a deal. And so yeah, I'm just curious to see what kind of evolution you're feeling around this area of seller knowledge and seller awareness of the mechanics of the deals.
Well, Louis, the question is really timely because we actually have on deck slated on our side to do a session on this topic precisely, or specifically around the importance of the consideration for the legacy, and kind of what do you want and what do you not want. I think that we've been stuck historically more in the idea of where someone got a job, and it's like, whether you enjoy your job or you don't enjoy your job is entirely irrelevant. The fact of the matter is, you got to go to work. You do your job. You report to whoever you report to. You do as you're told, and satisfaction, job satisfaction is kind of irrelevant, right? And that's I don't know what period of time, but let's say 50s, 60s, 70s, as things started to change, maybe 80s or 90s, I don't know, somewhere around there. And so, I kind of look at this as the same idea, is that, and I think we're kind of late to the game here in terms of having these conversations around what is it that you want to ultimately do, right? Why are you considering selling? What is it? What problem are you trying to solve? Are you moving towards something or away from something? So towards something is, I want to play more golf. Away from something is, I am tired of all these support tickets, or I'm tired of firing people or managing people, or I'm tired of dealing with difficult customers or something. So are you moving away from something, or are you moving towards something? And so I think that going through this exercise, and when we have conversations with groups that are considering selling, even if it's not now, it may be several years down the road, and we often get calls from groups. I had a call yesterday with a fellow, and maybe he was 58, and it might be 58, 59, 60, 61, 62, but they're having these conversations about, well, I know I need to do something in the next few years. Let's talk about what this market looks like, and at least sort of set myself up for it, and to understand what is your next phase, right? A next phase of life. And I know that Scott Scrogan at if you know Scott,
Yeah, I
yeah,
do.
and Arlen are big on this topic, and I'm a firm believer in it. I think that the other piece that people are missing, and certainly I think that buyers miss, is the importance of it, because if the seller doesn't have the raison d'être, then they may end up being in a position where they have get cold feet, right, and pull the plug on the deal, and it has nothing to do with you as the buyer. It's because they all of a sudden in a panic that what am I doing, and the regret that potentially could set in afterwards. And this is real. I mean, this happens.
Yeah, certainly. Um, there's so many variables. Obviously, the directionally, I feel like you've just unlocked something that I hadn't really thought about. This concept of whether they're running towards something or running away from something. I feel like the motivations can be wildly different in each of those
Yeah.
scenarios. And I'd never stopped to think about it that way. So definitely, I'll spend some time unpacking that. I think, back to some of the mechanics of deals. You mentioned how some of them kind of have to take a step back and figure out, what do we need to get ready before we are ready for a transaction, so to speak. And I think there's a number of things. There's obviously the finances, the way that valuation engines still look at EBITDA as a primary driver of multiples or of valuation formulas. And I was watching this interesting podcast the other day. Or listening to this podcast. It's called the Knowledge Project. Shane Parrish interviewing, and I'll have to look up the name of the guest. He's now consulting on forensic accounting related to M&A and stuff like that. And so they got into the conversation about EBITDA specifically. And I know this is a sore point for everybody. EBITDA, EBITDA, like who cares? What really matters is perhaps cash flow. But he was talking about how it's interesting that most people don't look at the accounting notes when they go look at a set of financial documents for a company, to realize that the way that you interpret anything that's written down could be wildly different based on the notes that are completely abstract and up to the preparer to kind of to put together. And so I'm curious how much EBITDA is still sort of the flag in the ground in terms of valuation and multiples versus getting a little bit more nuanced on some of the other mechanics of the business.
Well, I think it's kind of that garbage in, garbage out situation, right? So EBITDA can certainly be manipulated, and so to understand what the underlying drivers are of the EBITDA calculation, and actually more specifically the adjusted EBITDA figures, because it's the adjustments that can move the needle much more so than just looking at the kind of general operations.
Yeah.
And the overhead is, there's perhaps some savings that can be had in overhead, but the kind of real opportunity lies in the cost of goods sold, the delivery model, the pricing, and so forth, is where you can really move the needle. And obviously, if you go from an office to a remote team, you can have realize some pretty good savings there. But most of it's going to be the variable operational aspects, and so looking at the adjustments and the assumptions that are made, and how that business is structured and what that business is going to look like under a buyer's environment is key. And I think that someone like us can put forward an EBITDA number, and when we do it, we put disclaimers to say, look, these are our assumptions, right? Because they're assumptions that we're making, but we're not necessarily saying like this. We're not arguing that this is the EBITDA number and there's no other interpretation. It's that this is the EBITDA number under these assumptions, and if you have different assumptions or a different model that is going to mean that some of those add backs, for example, aren't relevant, then hey, there's an argument there. The only challenge is that the person who doesn't need to hire somebody because they've already got that role means that they can realize a higher EBITDA number and therefore justify paying more than someone else. And so we can have this argument till we're blue in the face around what the number should be, but the reality is that there are people who are going to be calculating their own number and coming up with an offer that may be higher than yours, and it is what it is. So
Yeah.
that's kind of where it's like beauty is in the eye of the beholder, right? And the beauty is everything. It's the numbers and it's the whole package. So people are going to attribute their own value.
Well, maybe one of those beauty components is multi-year contracts that MSPs might have with customers seem to still be one of those beauty components. But what I'm curious more so is whether some of the mechanics of the rate of change that we're seeing right now, whether it's AI or this, perhaps a little bit of this early warning system of a shift to outcomes-based pricing as opposed to just keep the lights on pricing, is perhaps influencing a bit of how we think about contracts. If retention and the proof of retention is maybe taking a bit of the seat of like multi-year contracts, because the MSP is consistently showing proof of value and the customers are just therefore not leaving, can that replace multi-year contracts as far as one of those deal mechanics pieces, you think?
So when you're talking about proof without contracts versus proof with contracts and the retention piece that comes associated with it.
And I'll explain why. That's exactly right. I see many MSPs that advertise no contracts. And one of the reasons is because every other MSP that sat in front of that prospect said they needed a 3-year contract to do business with
Right.
them. And so like suddenly a no contract MSP seems really appealing. And I think there's some, intrinsic value to the idea or the notion that the MSP has to consistently prove its value to keep their business. And I think that is one of those maybe loyalist bits that really brings a customer to you, because like, hey, I'm not tied down, but also I like that they are putting themselves on the line to prove that they're delivering value to
Right.
me, every month, every year, however long. And so I'm curious how much complacency, first of all, happens as a result of long-term contracts, and whether that on the back end of a deal where a 3-year contract with a customer looks appealing, but the service complacency is maybe bringing that excitement down a bit, versus an MSP that's delivering proof of value and service because they are kind of need to refresh that justification with customers on a regular basis. It's a bit of an abstract thought, but I'm
Yeah.
curious, like if there's been a shift in the market just with this kind of conversation around outcomes-based consulting now taking a little bit of a higher level in the hierarchy of needs.
Yeah, look, I mean, I'd love to have a larger discussion than we can have here on this topic, because it sounds like there would be a lot of different perspectives. I can tell you from our side, we end up with various arguments from the seller as to why they don't use contracts. So it could be what you said, like I'm going up against groups that have contracts, and so it's easier for me to win without them. I think a lot of them, at least their outwardly justification is, we don't want to have to hold someone's feet to the fire and have them stay with us if they don't want to and they're not seeing the value. So stay with us if you want to, stay with us if we're adding value, but hey, if we're not, feel free, you can leave. And so that's a kind of a value proposition, I guess, to some degree for the customer, but also the justification, and maybe it's a justification because it's just easier to not have contracts, right? To get a customer to sign a contract is more difficult. The problem is that you need to put yourself in the perspective of the buyer's shoes, and the reality is that the more risk that a buyer takes on, the less they're willing to pay, or at least the less they're willing to pay upfront. The more risk that the seller takes on, the more they're going to want to realize for the business. And so if there are contracts in place, that secures that annuity stream for the buyers, and they're willing to, as I say, either pay more or at the very least give better terms. And so there's lots of reasons for it, but I still think that the one who has the contracts in place at the end of the day is going to end up with a better deal structure. I mean, it's not, I think, that's how it's playing out. The challenge with contracts is where there's an end date of those contracts where they need to be renewed, and now you need to go back to that customer and kind of sell them all over again, right, to get them to renew. And it's one of those things, like on our credit card, when we see the same charge from Amazon or Spotify or whatever it is every month, you just kind of get blind to it. It's like, oh yeah, there's that charge again. And so, that's why SaaS is one of the reasons why SaaS has done so well, particularly as long as it's not a huge line item. It just kind of repeats itself. And so the idea of having like auto renew contracts is an attractive one, because you never really need to talk to the customer. It just auto renews.
Yeah.
And unless they give notify otherwise, as long as there's a price escalation clause in there. So yeah, I think that there's arguments there that make sense, but they're not going to hold weight with buyers at this stage.
Okay. Yeah. It's always good to check in on how these things are evolving, because I find that some of the changes are small and nuanced. And so suddenly we find ourselves looking back, and that initial 1 degree change is now a 20-degree change. And so I just love revisiting. One of the things that I am revisiting right now is I was asked just yesterday evening to provide a prediction. I sit on the SaaS Ecosystem Advisory Council for the GTIA. And every year we kind of get asked to provide some predictions on next year, what's happening in the SaaS ecosystem or with MSPs and so on. And I wanted to run this prediction by you. Pull out your own crystal ball, if you will. But I've been steeped in this customer success conversation for the last year or so. And by that, I mean this very interesting pivot that MSPs are making as commoditization has kind of settled or continues to deepen. And in fact, they are realizing they do need to have conversations with customers. They can't kind of let that be automatic or just be complacent and so on. And so my prediction was that with the AI revolution, a lot of the level one types of things, whether it's ticket triage or easy password resets or easy things that an agentic type of thing will do, there will be a ton of margin compression on that lower tier of support that MSPs deliver. But that kind of opens up opportunity to expand on the much more customer-centric relationship type of things, like a VCIO program, a customer success program. And I'm curious to ask you from your vantage point, if you're seeing interest from buyers on a well put together customer success program, a well put together VCIO program, if retention and expansion, which is what these things tend to deliver, are taking a bigger part in the conversations than before.
Yeah, so this is something that we've integrated into our onboarding process as part of our understanding of the background of a seller's business. Is to what degree are they involved with, do they have a VCIO? To what degree are they implementing QBRs? Who's doing it? And are they true QBRs where it goes beyond just like a kind of a regular check-in and upselling, but really trying to solve business problems with technology, and may lead to larger projects and deployments and so forth. I kind of liken this to so what we didn't really talk, Luis, but about this, but we cut our teeth in the web hosting industry and data center space, and that's where we started a long time ago. And so we've done hundreds of transactions in the hosting and data center space, or at least being involved in them. And one of the things that we would hear there, more so than MSPs, although I've had it with MSPs as well, which is, and I'll get back to your question, but I'm going to liken it to the same kind of idea, same concept, is to say, well, I want to sell my business for this, but I also have our website, and hey, we've invested a lot of money in our website. It's like state of the art. It's amazing, and the SEO rankings are really great, and so it's a huge lead generator for us. And so as a result, our website on its own, never mind the business, is got a lot of value. And we look at that as like an additional asset that we want to get a lift on our valuation for. And my answer is, well, okay, nobody's really cares about the website. What they care about is what is the outcome of the website, which is that traffic that you're talking about. If you're actually if what you're saying is actually true, that traffic will translate into additional sales. So what we should be seeing as a corollary is to see that the sales numbers are increasing, right?
Yeah.
And so that's your organic growth. And the importance of organic growth in valuation is key. To simply growth entirely through acquisitions is not a great strategy. So buyers are looking for businesses that have some underlying growth organically. And of course, that can come from a lot of different ways: price increases, upselling customers, and cross-selling them, and so forth. But it's also adding new logos. And so if your website is generating those additional logos and growth, then that's really where the value is. So what they're going to end up doing is they're going to pay more for your business because there's a growth engine there that's been attached to all this SEO work that you've done. So let me go back now and answer your question and say that it's implementing a VCIO program and QBRs in and of itself isn't what people are interested in, although it is symptomatic of the fact that you're probably operating at a higher operational maturity level. It's also indicative of probably instills confidence in a buyer if other processes that you have that are kind of beyond the early stages of what many MSP owners might have. And so you sort of takes you into another bucket, and the more a buyer sees of that, the more confidence that they're going to have that they're buying a real going concern. But then going back to this final point, which is all of that ultimately is going to be a driver of organic growth, and so that is really what they're looking for. And so it's well, you're growing at 15% a year. Where is this coming from? Well, it's coming from the fact that we have these really effective QBR meetings, and our VCIO is kind of knocking it out of the park with uncovering new opportunities. And so I think that's kind of how I would answer that question.
Yeah.
So I think it's sort of both, but.
Yeah, no, that's fair. We just see so many MSPs already having this conversation publicly themselves. They're shifting away from tactical, historical looking reporting to really business outcome driven strategic conversations and all these things that are putting the customer back in the center, as opposed to what feels like has been a lot of MSP centricity for the last 20 years, as we figured out our own operational maturity, our own standardization, our own tech stack, et cetera, et cetera. So it is an interesting evolution for sure. Now, something you mentioned, organic growth. When MSPs, on the flip side of that is, of course, growth by acquisition. And I've long had this thesis that obviously the market drivers of things like interest rates or the ratio of buyers to sellers maybe kind of deal with some of these things to some extent, but I've yet to see a slowdown in a simple like if an MSP goes out and joins forces with two other MSPs, and they went from a $2 million shop to a $6 million shop and did nothing else, like no integration, nothing, but suddenly it's a $6 million business, that may still earn them a higher multiple just by fact of the bigger top line number. And so I'm curious if these diligence nuances are driven primarily by the market, interest rates being higher, perhaps buyers are more diligent, but at the same time, when there's so many buyers, they perhaps don't pay so much attention to things like that, and they're paying for buying money effectively. And so I'm curious, where are you seeing some of the shifts in this, organic versus acquisition-based growth?
Yeah, I think that is a perfect example of where the more sophisticated buyer will put their hand up and say, I'm out, right? Because they're going to look at this and say, well, hold on a sec. This isn't a 1 + 1 = 3, to use that well overused analogy. this is a 1 + 1 = 2, because you guys have done no integration here. There's a ton of redundancy in your
Yeah.
tech stack.
Well, in reality, it becomes a 1 + 1 = 1.5. If you think about it, like they're actually
Sure.
not achieving any efficiencies, and thereby, potentially reducing the actual efficiency overall by coming together. So it's interesting.
Yeah, no, like 100%. And there was some discussion at AT Nation, in fact, on the fact that, hey, if all you're trying to do is bring two businesses together, that doesn't have the value. I actually would argue that there are, like you had said, the reality is there are far more buyers than there are sellers. There are people who are, I'll say, virtually desperate to get a deal done, willing to overpay, and probably willing to say, look, this isn't the way I would like it, but I can probably fix it. And so, they're going to buy it, and with the idea that this is going to be a project, and they know it's going to be a project. But I think in the end, they'll find out that it was more work and cost more than they thought it was. And in doing so, probably lose, some of those customers as well. So there's a bit of a rebuilding process, and that this idea of just kind of bringing two companies together is far more, as you said, there's nuanced aspects here to look into in terms of integration. And there's the tech stack, there's the people, there's the culture, there's the operational aspects of it, and the back office and so forth. So the real value is when you can bring all that together, increase the margins, and have a kind of a cohesive business. And then, of course, to do that again and achieve the scale.
Yeah. Perhaps on the unsophisticated side of that scale is maybe lenders that will go and provide an SBA loan to a small business that wants to acquire another business. And I'm curious if you're seeing a lot of this type of lender-based acquisition funding that is not your typical private equity engine. And what kind of deal mechanics, if any, are evolving in that space as funds become available to businesses to go do some of these transactions themselves?
Yeah, so I think that the first thing, and I go back to an analogy that I think is kind of near and dear to our heart. Luis and I are in Vancouver together here, and if there's one thing that people talk about in Vancouver, aside from the weather, it's real estate. And when someone talks about real estate and they say, well, the market's going up or the market's going down, like what are we talking about? Are we talking about like Canadian real estate? Are we talking about US real estate? Are we talking about real estate in Vancouver, or even within Vancouver? There's different regions, of course, and markets are doing different things. And so to talk about buyers here, and private equity versus strategic buyers, you really need to be talking about like the size of the business, because private equity is really only interested in minimum 500,000 in adjusted EBITDA, but typically it's going to be much more commonly cited at 1 million, and in some cases even 2 million or more. So they're not looking at the iceberg of example that I talk about, which is the majority of the MSPs are below the waterline. You don't see them. Just the ones poking up are the bigger ones, and the private equity groups and the larger strategics are looking at those ones. But the vast majority of activities happening below the waterline you can't see, and these are the $1, $2, $3, $4, $5 million transactions. And so first of all, SBA only goes up to 5 million, so that kind of caps it right there. But the answer to your question is, yeah, we certainly see a lot of groups that want to use an SBA loan. But the challenge for those buyers is that the sellers now, because there's so many buyers, the sellers have options, and if given similar options, they will rarely choose an SBA buyer who's going with the SBA route. Simply because there's just more complexity, more uncertainty, and a longer time horizon to get a deal done. So anybody who has cash on hand from their balance sheet, who's got investor backed, family office backed, those ones are going to end up, all things being equal, right? I mean, obviously fit is extremely important, and we're big advocates of fit. But that piece is going to cause some challenges. So. But we do see a lot of it, and that's in the U.S. Of course. There are Canadian alternatives through the BDC program as well.
Yeah. Yeah. Well, one of the questions I told you backstage that I'd ask you is what kind of topics are kind of making its way into every one of your conversations? At least I tend to deal in quotes. A lot of my life is kind of surrounds quotes, little pithy things that I kind of pick up on, and they kind of start to define a certain way of go to market in life. And I'm curious, this is one of those things for you that's kind of been percolating all your conversations and thoughts lately.
Well, let's say AI aside.
Yeah, please.
Please, yeah, exactly. So, I think from our perspective, like any business, right? You grow, and then you realize, hey, my systems and processes are kind of being tapped out, and we need to double down. And so, we've had many conversations with clients over the years who say, we're not interested or wanting to take on really any new business. I mean, if it's a layup, we'll take it, but we're really not going after it because we need to hire more people, we need to train more people, we need to we're short on our L1s or whatever it is. And so they need to invest in the business and invest in processes and systems, and then kind of come out the other side saying, all right, now we're ready to kind of take things to the next level. And I think that's sort of indicative of where we are right now. Like, we've had some great success. We were kind of outgrowing our systems and processes on our end, and so we're constantly trying to sort of stay ahead of the market and improve that. We've got a pretty good our reviews and our experience that our clients have is I think really good, and the social indicators are saying so, but we don't want that to slide, and so we need to invest in kind of next steps. And so I think that's kind of from an internal perspective what we're trying to do, and also stay on top of the trend. So yes, of course, AI is part of that, and trying to make sure that we have a good experience for buyers and sellers that we're working with.
Yeah, I think this is to summarize one of the quintessential things for MSPs to differentiate is quite literally focus and execution. And I wanted to maybe ask you if there was one lever for an MSP to go pull on that could drive their valuation significantly in the next 2 to 3 years. What would that one thing be?
Well, there's lots of fine print under it, but the revenue is really the key. I would to get yourself into the next tier. It's the valuations are not linear, and so to move yourself into the next valuation bucket is going to be give you a good size lift. Now, having said that, that might take investment, which actually means your profitability might go down for a short period of time. It means that you're not just trying to move the revenue number for the sake of revenue, and you're selling a lot of hardware at low margins. I'm talking about maintaining industry leading or best sort of mid-range margins, but moving that top line number is kind of going to be your biggest driver. So that's the quick answer. As I said, there'll be people who are going to push back on that, saying, well, not all revenue is the same revenue, and I realize that. So there's an expanded conversation there.
Yeah, this is, I think, also as MSPs evolve and realize that next stage of revenue is the key driver. I think a lot of the focus kind of shifts over to building that turnkey sales engine, the marketing engine, and driving that revenue. But at the same time, that focus takes a little bit of the eyeballs off of the service delivery and some of the other aspects that drive retention and expansion, interestingly enough. And so I think there's a little bit of a game of substitutions in some of those situations. But This is where the maturity of being able to tackle all these things over time at the same time to ensure your retention and expansion aren't suffering as part of, building out a turnkey sales engine, is a big deal. And I think you see those levers start to equalize a little bit once you get into the 10 million plus. But below that, there seems to be always an either or. And this is just me, with thumb in the wind type of assessment based on just the conversations that I have casually. But I'm curious your thoughts on what you see out there with the real data and some of the real situations.
Yeah, look, I mean, this goes back like to the AI discussion, right? Of realizing additional efficiencies from AI, and if you do that, you've got better margins. Now you can reinvest in other areas. Part of the rationale for not focusing on organic growth is, I don't like it. I'm not good at it. We tried it, didn't work. We hired a salesperson for 150 grand a year, and 6 months later they delivered nothing, and we got rid of them. And so these are the types of stories that I hear over and over again. But it's going to burn a little bit less if you've got automation and AI to increase your margins. But also if you're I've seen good margins out of MSPs who their whole kind of objective is to eliminate tickets. I don't want any tickets. So how can we ensure the kind of the best service and delivery, and have an experience where the customers just don't ever contact us, right? And so there's significant range in terms of the number of tickets that groups have, and that you can, because the last thing you want to be doing is driving more customers in the front door while a number of them are leaving out the back door. So I think you really need to stabilize that, and that means getting your service delivery model sorted, and then optimizing the efficiencies, and then bringing more in the front door.
Yeah, interestingly, I think this has always been the business case for automation is so you can spend more time on the things that matter.
Yeah.
And so I think AI is just more present to the end customer than some of the other automation that we've been talking about for 20 years ever has been. And I think one of my other predictions actually was a little bit of a price transparency era, perhaps, in that the customer is aware of like potentially the efficiencies that an MSP is gaining by using AI in their business. And so it might actually bring them to question what they're actually paying for if that value is not being delivered somehow else, whether it's through the expanded VCIO program or a true strategic level of engagement or things like that. So we might be sort of in this interesting gray, muddy area while this pricing transparency kind of takes hold. But that's something that I've started to see in some of the news articles already, whether it's the big Deloitte consulting firms where they got sued because a customer, they went and boasted about all their AI efficiencies, I believe, and a customer sued them because like, well, you got all these efficiencies, where is the reduction in our price type of thing.
Right.
So, yeah. So I think that'll make its way.
Yeah, that's a good point. It's sort of salt on the wound, right? You're still paying what you were paying, and we're making all this money through efficiencies. I mean, I think that there's that demonstrating value through, as you said, the QBR, VCIO roles, the check-ins, and the demonstrate, like the demonstration of values, whether it's security reports and going through those and explaining where the value has been delivered. But selling, it's like it's in a lot of ways, a lot of this is insurance, right? Like you actually never want to make an insurance claim. So everybody pays for insurance, and we're all paying more and more for insurance. I sure as hell know I am. And that's to some degree that's an MSP's business is keeping the lights on, but also there's a significant insurance piece to this.
Yeah, and the fact that we'll be penalized for using it. So even when you do need it, you avoid using it.
Yes,
So,
true enough, right? What's it going to cost me to pay out of pocket versus
the rate increase, for having a claim, yeah. Hartland, this has been a fascinating discussion. I think it warrants, doing these check-ins because these are very, very fast-moving times. A lot of the mechanics inside of these deals seem to be evolving and changing, and It's always fascinating to get an insider's view and perspective on these things. So I appreciate you hanging out for a little bit, spending some time with me today. So thank you.
Yeah, no, likewise, Luis. I really enjoyed this. This has been fun for me, and hopefully listeners have got some value as well. So, yeah,
For
thank
sure.
you.
Well, folks, thanks for joining us today. This has been Hartland Ross, founder and managing partner of the Host Broker. And we're here on Fridays most of the time. I will say this quarter has been a little bit crazy travel-wise, and which has kind of precluded me from delivering the usual Friday afternoon gathering for folks. But whenever I can get it on the schedule, I'll be here on Fridays at noon Pacific, 3 p.m. Eastern. You can also find us at mspconfidential.com or on the ScalePad YouTube channel at Go ScalePad. We'll hope you check out some of our previous episodes and join us for the next one. Until next time, thank you so much again, Hartland, and we'll see everybody soon. Ciao.
Thank you so much. Take care.